Something big is hiding behind the record highs of the stock market right now, and almost nobody is talking about it. While the S&P 500 keeps setting new records, a handful of the biggest companies driving that index have quietly lost nearly a fifth of their value since late last year. That's not a small crack. That's the kind of split that has shown up right before some of the worst market crashes in history. Let's start with the hook everyone forgets. An index fund feels safe because it sounds diversified. 500 companies spread across every industry can't all fail at once, right? But here's the uncomfortable truth. A small group of tech giants now makes up nearly 40% of that entire index. When you buy the S&P 500 today, you're not really spreading your risk. You're making one giant concentrated bet and calling it diversification. This isn't the first time investors have fallen into this trap. Rewind to the late 1990s. A cluster of tech names carried the market on their backs for years, gobbling up a bigger and bigger share of the index as their earnings exploded. Investors assumed that trend would last forever. It didn't. When those earnings finally stalled, the unwind was brutal, and it dragged the whole market down with it, even companies that had nothing to do with technology. But what most investors fail to realize is that concentration itself isn't the real danger. Earnings are the real trigger. Money doesn't flow into a handful of stocks randomly. It follows profits. As long as those companies keep printing record margins and record revenue, capital keeps piling in and concentration keeps building. The moment earnings disappoint, that same money rushes back out just as fast, and that's when a slow correction turns into a full unwind. So the real question isn't whether concentration is high. It obviously is. The real question is what could actually break these earnings. Historically, there's only one force powerful enough to knock even the strongest companies off their growth path, and that's a recession. When consumers pull back and businesses slash budgets, no brand, no innovation, and no hype cycle is immune, here's where it gets interesting. One of the most reliable early warning signs of a coming recession isn't the stock market at all. It's how willing banks are to lend money. When lending standards tighten sharply, credit dries up, businesses stop expanding, hiring slows, and earnings usually follow it downward within months. That pattern showed up before the dot-com crash, before the 2008 crisis, and again in 2022. Right now, that warning light isn't flashing. Bank lending standards have actually loosened dramatically over the past 2 years. That's the main reason this current wave of concentration hasn't triggered a bigger collapse yet. But conditions like this can shift fast, and when they do, they rarely give investors much warning, so here's what this really means for you. Record concentration on its own isn't a crisis, it's a warning label. It tells you exactly where the risk in your portfolio is actually sitting, whether you realize it or not. The smart move isn't panic. It's awareness, watching credit conditions closely, understanding what's really inside that diversified fund, and being ready to act before the crowd figures it out.